The stock market can look intimidating. Numbers flash across the screen. Prices jump up and down every second. Financial news talks about billions of dollars being gained or lost before lunchtime. From the outside, it feels like a world built for economists and professional traders. But underneath all that noise, the stock market is based on a surprisingly simple idea: ownership. Let's use Apple as an example. Imagine Apple is worth $3 trillion. Instead of one person owning the entire company, that ownership is divided into billions of small pieces called shares. Each share represents a tiny ownership stake in the business. When you buy one share of Apple, you aren't lending the company money. You're becoming one of its owners, although your ownership is incredibly small. That raises an important question. If you're buying a piece of Apple, who are you buying it from? Most people assume they're buying directly from Apple. In reality, that's almost never what happens. Once a company has sold its shares to the public, those shares are usually traded between investors. Think of it like buying a home. When you purchase a house, your money doesn't go to the construction company that built it years ago. It goes to the current owner who's decided to sell. The stock market works in much the same way. Every day, millions of investors decide to buy shares, while millions of others decide to sell them. The stock exchange acts as a marketplace, matching those buyers and sellers in fractions of a second. It's no different from a marketplace that connects people buying and selling cars, homes, or collectibles. The only difference is speed. Thousands of transactions can happen before you've even finished reading the sentence. But if investors are simply trading shares with one another, what decides whether a share of Apple is worth $200 today instead of $198 or $205? That answer is the reason stock prices can change every single second. And once you understand it, the entire market becomes much easier to follow. Now that you know the stock market is simply a place where investors trade shares, there's another question to answer. Why does a stock cost $200 one minute and $201 the next? The answer isn't hidden inside a complicated algorithm. It comes down to negotiation. Imagine someone lists a bicycle online for $500. If nobody's willing to pay that price, they'll probably have to lower it. But if 10 people all want the same bike, someone will likely offer $520 just to make sure they get it. The stock market works on exactly the same principle. Every investor has a price in mind. Some are willing to sell Apple for $200. Others won't sell unless they receive $202. At the same time, buyers are placing their own offers. One buyer might offer $199. Another is happy to pay $200 immediately. The moment a buyer and a seller agree on the same price, a trade takes place. That agreed price becomes the latest market price you see on your screen. Now multiply that process by millions of investors around the world. Every second, people react to new information. A company reports stronger profits than expected. More investors want to buy. Demand increases. Sellers realize they can ask for a higher price. On another day, disappointing earnings or unexpected bad news might make more people want to sell than buy. To attract buyers, sellers begin accepting lower prices. The stock falls. Notice something important. The price isn't changing because the company itself is constantly becoming more or less valuable every second. It's changing because investors are constantly changing what they're willing to pay for a tiny piece of that company. That's why emotions can move markets just as much as facts. Excitement creates more buyers. Fear creates more sellers. And because millions of people interpret the same news differently, prices are always adjusting. So if the market is nothing more than buyers and sellers agreeing on prices, what actually happens when you press the buy button in your investing app? Where does your money go? Who receives it? And how do those shares end up in your account? That's where the process becomes even more fascinating. Let's say you've decided to invest. You open your brokerage app, type in Apple, choose one share, then press buy. It feels almost instant. A few seconds later, the stock appears in your portfolio. But behind the scenes, several things happened in the time it took you to tap your screen. First, your broker receives your order. A broker is simply a company licensed to buy and sell investments on your behalf. Platforms like Fidelity, Charles Schwab, Robinhood, and Interactive Brokers all act as brokers. Your broker doesn't own the shares you're buying. Its job is to find someone who's willing to sell them. The order is then sent to a stock exchange or another regulated trading venue where powerful computer systems compare millions of buy and sell orders every second. If someone is offering to sell Apple at the price you're willing to pay, the trade is matched almost instantly. Ownership changes hands. The seller receives the money. You receive the share. Your broker then updates your account to show that you're now an Apple shareholder. One detail surprises a lot of people. When you buy a share of Apple today, your money usually doesn't go to Apple itself. It goes to the investor who sold you their share. That's because most trading happens in what's called the secondary market, a marketplace where investors trade shares with each other after a company has already gone public. Companies typically receive money only when they issue new shares, such as during an initial public offering or IPO, or through certain later share offerings. After that, investors are simply exchanging ownership. This is one of the reasons the stock market is so efficient. Millions of people around the world can buy or sell within seconds without ever meeting each other. All of it is coordinated electronically, allowing ownership to move from one investor to another almost instantly. Now that you know how a trade actually happens, there's one final question. If investors are constantly buying and selling shares from one another, how do people actually make money in the stock market? And why do some investors hold their shares for decades while others buy and sell within minutes? At this point, you understand how stocks are bought and sold. But one question remains. If you're simply buying a share from another investor, how do you make money? There are two main ways. The first is through capital appreciation. Let's say you buy one share of Apple for $200. Over the next few years, Apple launches successful new products, grows its profits, and earns more money. As more investors want to own a piece of the company, demand for the stock increases. Eventually, someone is willing to pay $250 for the same share you bought for $200. If you decide to sell, you've made a $50 capital gain. The second way is through dividends. Some companies choose to share a portion of their profits with shareholders by paying regular cash dividends. If you own the stock when that dividend is paid, the money is deposited directly into your brokerage account. Some investors spend those payments, others automatically reinvest them to buy more shares, allowing their investment to grow over time. This brings us to one of the biggest misconceptions about the stock market. People often believe successful investing means buying today and selling tomorrow for a quick profit. That's trading. Long-term investing is different. Instead of trying to predict what a stock will do next week, investors focus on owning strong businesses for many years. History has shown that markets can be unpredictable in the short term. A company's stock price might rise or fall because of earnings reports, interest rates, economic news, or simply changing investor sentiment. But over longer periods, stock prices have often reflected the growth of the businesses behind them. That's why many long-term investors choose diversified index funds. Rather than trying to guess which single company will be the next winner, an index fund allows you to own hundreds of companies with one investment. If one business struggles, others may perform well, reducing the impact of any single company. So when people say they're investing in the stock market, they're not gambling on numbers flashing across a screen. They're buying ownership in real businesses that employ people, create products, generate profits, and over time may increase in value. Once you understand that, the stock market stops looking like a casino. It starts looking like one of the simplest ways ordinary people can participate in the growth of the world's largest companies. And that's the biggest lesson of all. The stock market isn't a machine that creates wealth, it's a marketplace. What determines your success isn't how often you trade, it's how wisely you choose what to own, and how patiently you're willing to own it.